Hello everyone and welcome to the Compak Asset Management Market Wrap for August 28, 2020. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap that you've been tuning in for the last 30 years into every day. You get a 1-hour update and I appreciate all of you that tune in. And if you'd like to get that and you do not have access to a radio station, just download the app. Just go to the Apple Store and type in Market Wrap with Moe, as it says right there on the screen. Just click on that and you will get Market Wrap with Moe on a daily basis. It'll just be downloaded to your iPhone or your mobile app, and then you can listen to it at whenever you want to. Today I'm going to talk about three major subjects. Take a look at what happened this past week, pandemic update, what's going on with COVID-19, where are we now, U.S. economy, interest rates and inflation. Obviously, we had Jerome Powell make a major announcement on interest rates. This is something as significant as we saw in 1980, and I'll talk about that with what Paul Volcker did. I'll talk about technical analysis. Let's take a look at the charts, the language of the markets. What are the markets trying to tell us? Markets closed at all-time highs, the S&P above 3,500, NASDAQ also up sharply for the week. We had the best week for the S&P in nearly 2 months. Wonderful week in the markets, just continue to go higher. Everybody says they can't, but they will. So let's just go with the market rather than guessing where they'll go. Let's start with the pandemic. We are starting to see a slight uptick in the number of people going through TSA. These are checkpoints at the airports. More people go through the checkpoint. That means more people are traveling. We fell off right off of a cliff. We were down nearly 95%. Now we're still down somewhere around 60% or lower. So we are back up, but we're 60% less. American Airlines said it's going to lay off 19,000 people. Boeing has said it's thinking of closing down one of its 787 plants in Washington. So we are starting to see the layoffs starting to come. And they have been delayed because of, we saw all the fiscal stimulus that the Federal Reserve and the federal government had done. But we are running out of that fiscal stimulus. I think once the unemployment numbers start to go up, we're 64 days, 65 days away from the election. So I think the Democrats and the Republicans are going to say, "Oh, we don't want the public to get upset. Let's figure out something." That might give a boost, or they might just dig in their heels and say, "Let's see what happens." Airline and credit card spending, you can see also coming back up, but we're still down somewhere around 85% from airline credit cards. So we are coming back, but we're not there yet. So that's something that we have to think about. We are looking at hospitality. I'm not talking about staying at luxury hotels. I'm talking about people that are admitted to the hospital. That's what I'm talking about. It is down in Arizona, 72% for COVID-19 patients from the peak to where we are now. So what we're seeing is if people are getting sick, less people are getting sick, and the number of people going to hospital is also going down. That's why we've seen some of the intensity of COVID-19, the fear of COVID-19 coming down. Unfortunately, we still have the infection numbers there, and I'll talk about they've come off the peak also, but there's still somewhere around 46,000 people got infected today, and that is still a very large number. Here we're seeing the number of infected in blue. It was above 60,000 for a period of time. Now we're down to 46,000 as far as the numbers go, as far as daily infections. The death rate also has come down, but still at about 1,000 people a day. That's where we are. 1,000 people are still dying a day of COVID. I know, if we were at war and 1,000 soldiers, body bags were coming out a day, I think the nation would be up in arms. Right now, 1,000 people dying a day, it's still somewhere just a television screen. It's just on the TV. It's not people directly impacted. Unfortunately, there's a lot of people that are being impacted directly, but we're not seeing the widespread hue and cry of 1,000 people dying or 180,000 dead across the country. We're looking at vaccines. I used to show you, last few weeks, I've showed you the numbers of the vaccines that are being tested. vaccines in expanded safety trials, vaccine in large scale trials, and vaccines approved for early or limited use. So at this point, it shows you just the U.S. Last few weeks I showed you globally where we are. Right now I just showed you we have two that are close, that are in those large early approval stage. As I said, I would not be surprised to see by October something approved by the FDA. Even though it's not been fully tested, they might do it for emergency use. Mass inoculations with vaccine, December at the earliest, that's what I see. But once we get the vaccine, I think people will feel a lot more comfortable. Now, if you look at the number of people that have died per million, if you look at U.S. pandemics, this was the, if you look at the 1918 flu, we saw 6,540 people die per million. I mean, and we looked at the H1N1, that's the 1957. H2N2, that's what we saw in 1957, 666 people per million. Coronavirus, 555 people per million. And we look at H3N2, that was in 1968, 500. So we've had these pandemics before. They are not, it's something that we should be more prepared for, yes. We should have more resources committed to it, but we've had them before. It's nothing, we'll come out of this, we'll find the vaccine sooner or later. The sooner we find it, the better off we're going to be. If you look at death per age as share of population, you look at the number of people, we have the share of population is basically 2% of the population is over 85 years old in the United States. Number of deaths, people who died because of coronavirus, 31.5% of the people that died of coronavirus were 85 or higher. So if you're 85 and you get COVID, you have a problem. But when you're 85, you get anything, you have a problem. That's something, if you're between 75 and 80, that's 26% of the people that died that are between 75 and 84. And the same thing if you go 65, that's 21%, and then we can keep going down. So at this point, you can see that the younger they are, the less the potency or the fatality rate. So we have to figure out a way to protect the older population in the United States, but that's where all the money is too. That's where most of the people who have wealth is somewhere between 50 and 85. Those are the people that go on vacations and travel, they're retired, they're enjoying life, they've accumulated some money and working all the time, and that is the population that has what we call excess capital or disposable income. Fatality rate, you can see that it has come down from 12%, where we were at the beginning in April, to where we are now, we're down to 2%. So we have found better therapeutics where we are starting to, therapies where we are coming up with treatments. We've got remdesivir, which is helping. We've got the plasma treatment now, that is helping. And nothing is just you take a shot and fixes COVID-19 yet, but we'll come up with therapies that are going to be able to do that. You look at now, today we had an announcement by Abbott that they're going to have a test. It's called a 5-minute test. It's approved by it's $5 for the test. It's already in 15 minutes. It delivers the results. You get the free mobile app. That's 4 months ago. If you were listening to the daily edition of Market Wrap, I said we need two things, testing and tracing. Well, unfortunately, 6 months later, now we're coming around to testing and tracing. The more we do it, the more we can control it, or find out where the clusters are, who is getting infected, and then we can sort of try and stay away from those people or isolate those people, put them in quarantine. But until we know where it is, there's no way to cure it until we get to a vaccine. So we are getting there. How long will it take us to get 50 million tests out for, they're saying they'll be ready for October. So we still have a month and a half to go before we get there, a month and 5 weeks to go. So we'll see exactly how this turns out. U.S. economy and the interest rates. Well, we did get good economic news this week. We did see durable goods up sharply, 11% this week, much more than expected. We saw a number of economic reports come out slightly better than expected. What that means is the economy is coming back, but not as fast as everybody wants or sees. We did see something this week, which I talked about. The Fed announced that it has taken a flexible form of inflation targeting. What does that mean? Well, in 1980, in the 70s, I started out as a futures broker, and I was trading gold and silver, and all we had to do was buy something, it went up, and if it didn't go up, we just bought something and it went up the day after. It was called inflation. I talked to people and said, look, and do you think every inflation is going to go down? They said, no, it's never ever going to go down. The prices said, what do you think prices are going to be next week, next year? Higher. That was the assumption. Until Chairman Volcker came along and raised interest rates. He said he's going to crush inflation. I sort of laughed and said, we'll see. Well, he raised interest rates to 14%, crushed inflation, and it's dead. It's been 40 years since then. I remember buying gold at 800, and I've told you that gold story on the daily edition of Market Wrap. Someday I'll tell it to you again. But I broke even on my gold coin about 20 years ago. So you will hear that story from time to time. What that is inflation. But now we're seeing the exact opposite. Mr. Powell came out and said that they are going to, instead of focusing on deviations, focus on shortfalls below maximum. What does that mean in Fed that's Fed speak? What does that mean? It means that they're going to keep interest rates lower for longer. They said, look, if interest rates were 2% target, but it was below 2% for 5 years, we're going to take the 5-year average. If now it goes above 2%, we don't care. We're still looking at the 5-year average. So inflation can go up above 2%. They will keep rates low. What that means is interest rates are going to stay low for a long period of time. I said this, I talked about this in May of last year. If inflation starts to pick up, how much will they let it go higher? That's going to be the key. Will they just let it run rampant and say, no, we're not raising rates? Because we are going to go with they move the goalposts and say instead of looking at inflation in the short term, we're going to look at a 5-year average of inflation rather than just 1 month or 3 month or 6 month inflation number. And because the inflation has been lower than 2%, it'll give them room saying, okay, when the 5-year average goes up, then we'll raise rates. That could be 2-3 years down the road. But that will let the economy run a lot higher and let inflation run a lot higher. Will they let that happen? I think they will. I said the Fed is going to move the goalpost. They're going to move the goalpost, and that is they're going to have it'll be more flexible for them to keep rates lower. They want the economy to run harder. They want inflation to go up. The only question is if you move the goalpost, you still have to kick the ball through the goal. Japan has been trying to raise inflation for 20 years. They've been printing money. It hasn't happened yet. So will it do it? We'll have to wait and see. But at least they formalized the process and said they are going to keep not worry about inflation spiking up every here and there. It has to stay up for a long period of time before they raise interest rates. So interest rates are going to stay probably at zero for a long period of time. Now, what has happened with that? If you used to get excess return, we're used to invest in the market or buy a CD, and this was inflation, and you got more return than inflation. That changed in 2008 when the Fed started lowering rates. Then this was the inflation rate, this is the return. And you can see since then, this has been the inflation rate, and this has been your return. So you're getting negative returns, and that is the problem. It's the fear of missing out. Or Tino, as they say, there's no other alternative. So where do you put your money? So you have to look at the stock market, you have to look at dividend-paying stocks, and look at those. The Fed is forcing you into. Now, if the Fed causes inflation, when inflation happens, two things go up. Asset classes, stocks and real estate. Will it happen? Well, stock market is at an all-time high. Real estate has also come back up very nicely. Not at all-time highs, but it is looking good. So those are the assets. How long will it last? It could last 5, 10, 20 years before we start seeing problems. This is the Fed. The Fed balance sheet is up by $3 trillion. This is how much they've put in here. It has gone straight up, as you can see, since the pandemic. Let's take a look at the technicals. The language of the markets What are the markets trying to tell us this week? Well, we are still in this is the daily chart of the S&P. We're sitting right here, new all-time high. Once we broke above the February high, this is wave one, this is one, this is two, and we're in wave three. So somewhere we're going to get a pullback and come back down, and that will be a correction. Here's the weekly chart. Again, here's wave one. We had the fifth wave top. We've seen the ABC correction. Here's wave one, two, we're in wave three. Now we could see a wave four pullback, and you're looking at the wave, I've seen an extension, the wave five extension. If that happens, we could see that extension going all the way up to about 37.41. That's what I'm looking at right now, is 37.41. We're at 3,500. That's what, so 20-day moving average right now is somewhere around a correction, could bring us down to a fourth wave. That is around 33.86. Go to the 50-day moving average, the blue line, that puts us at somewhere around 32.60. Then we've got the 200-day moving average, and that is around 30.83. You look at the NASDAQ, again, this is the extension of the third wave. If we see extension there, that takes us to about 12,300. That's where it'll take us. We're at 11.7 right now. So that could see, if we see a pullback on this, we could see the market come back to the 20-day moving average, which is 11.2. We see the 50-day moving average, which is right here, that about 10.7 plus or minus, and then we've got the 200-day, which is 9,300. Those are support levels. This is the resistance. These are support. How high can this market go? No one knows. Let it go. Enjoy it. You're invested in the market. Just enjoy it. Make sure you have the right diversification. Make sure you have the right risk number. If you want to get your risk number, just contact us. We'll do that for free and tell you what your risk number is. What your risk number tells you is how much you can gain or lose the way you're invested in a 6-month period in your portfolio. Then you can look at your risk number. You say, well, this is how much I can afford, and that gives you a risk number. We'll put your portfolio and make sure that those risk numbers match. We'll do that for free. Just contact us and we'll do the analysis for you. Here's the weekly chart for the NASDAQ. Continues to move higher. Somewhere we're going to see the fourth wave pullback. When we do, it's still going to be a buying opportunity. Crude oil, so going sideways. We did have Hurricane Laura this week. It did strike, but it spared most of the refining facilities in Texas. So some of the refineries are down still around Lake Charles. There's 2 of them that are still down, but I think overall no major damage to the oil infrastructure. We are going to come back fairly quickly. That is why oil prices were up this week, but not up a lot today. Gold market, we did see a big update today. As the Fed said, they'll keep rates lower for longer. That means rates can stay where they are, and that pushes pressure on the dollar and will help the gold market to the upside. And so gold, I think, has reached a pretty $2,000 level, plus or minus. I think it's going to go sideways. We could see the fourth wave pullback, which brings us down to about 1875, right about here. We did see 2 weeks ago 1874. So if you see pullbacks to somewhere around here, we are at about 1950. 1850 could be a good buying opportunity. That's the weekly market wrap for August 28th. I'm Moe Ansari. Again, if you'd like to get more information on what we do, how we do it, simply go to our website at compak.com. Have a wonderful week. I will be back with you next week. Until then, good trading.